Stop what you're doing. Stop looking at your brokerage account balance. Stop looking at the red candles that flooded your screen on Friday. I want you to take a deep breath and look at the headlines that are breaking right now this Tuesday morning. On Friday, January 30th, the narrative was the apocalypse. We witnessed a historic wipeout. Silver collapsed. Gold took a massive hit. The sentiment across every retail forum, every comment section, and every YouTube channel was pure, unadulterated panic. They told you it was over. They told you the Kevin Warsh Fed nomination was the nail in the coffin. They told you the silver squeeze was a lie. But today, less than 48 hours later, the script has completely flipped. CNBC just released a report. Gold and silver rebound after historic wipeout. Another CNBC headline, Wall Street banks are saying buy the dip. Societe Generale states, the root was about positioning, not fundamentals. Do you see what is happening here? Do you see the game that is being played with your money? They shook the tree on Friday, they liquidated the leverage, they forced the margin calls that wiped out the retail trader, and now, right now, as I speak, the very same institutions that likely triggered the cascade are telling their wealthy clients to scoop up the metal at a discount. If you panicked and sold yesterday, you didn't sell because the silver ran out. You didn't sell because solar panels stopped working. You didn't sell because the debt crisis was solved. You fell for the oldest trick in the financial handbook: market structure overrunning fundamentals. In this video, we are not just going to read the news, we are going to do a forensic autopsy of this crash. We are going to read the fine print in the Societe Generale and FXStreet reports that explains exactly how the price was rigged down, why the thematic drivers are stronger than ever, and why this might be the most aggressive bear trap we have seen in a decade. This is the data they don't want you to see. To understand why Wall Street is buying today, we first have to understand exactly how they crashed the price on Friday. And to do that, we need to look at a very specific analysis coming out of FXStreet this morning. The headline reads, Silver's plunge shows how market structure can overwhelm fundamentals. Now, most people read that headline and scroll past because it sounds boring. It sounds like academic jargon. But that sentence, market structure overwhelming fundamentals, is the key to your financial survival. Let's break it down. Fundamentals are the real world. It's supply and demand. It's a mine in Mexico digging up ore. It's a factory in China building an EV battery. It represents the physical reality of the asset. Market structure, on the other hand, is the casino. It is the leverage. It is the margin requirements. It is the algorithmic trading bots and the liquidity pools. According to the analysis from FXStreet, what happened Friday was not a fundamental shift. We didn't suddenly discover a mountain of silver in the middle of the ocean. The demand from Samsung and Tesla didn't vanish overnight. The fundamentals are exactly the same today as they were when silver was $122. So, what happened? A liquidity cascade. When the news of Kevin Warsh's nomination hit the wires on Friday, it triggered a specific set of algorithms known as CTAs, Commodity Trading Advisors. These are robots. They don't have feelings. They don't care about solar panels. They only care about one thing: momentum. Because Kevin Warsh is seen as a hard money hawk, someone who hates inflation, the US dollar index DXY spiked. When the DXY spikes, the CTA algorithms are programmed to automatically sell commodities. They dumped billions of dollars in paper silver futures in milliseconds. But here is where the structure overwhelmed the fundamentals. As the price started to drop, it hit the stop losses of thousands of retail traders who were long with leverage. When a stop loss is hit, your broker automatically sells your position to protect their capital. This selling creates more downward pressure, which hits the next level of stop losses, which triggers more selling. Then the CME group, the exchange itself, stepped in and raised margin requirements. We discussed this in previous videos. They made it more expensive to hold a trade. This forced even more people to sell because they couldn't afford the new deposit. This is what Societe Generale, one of the largest banks in the world, is referring to in their report on Kitco News. They explicitly stated, the rout was about positioning, not fundamentals. Positioning means too many people were betting on the price going up using borrowed money. The banks saw this, the algorithms saw this, and they executed a flush. They flushed the toilet. They pushed the price down just enough to wipe out the gamblers. And once the gamblers were gone, once the leverage was washed out, the selling stopped. This is crucial for you to understand. If you own physical silver, or if you own an ETF without leverage, nothing changed for you. The metal in your safe is the same weight it was on Friday. The industrial shortage is the same. The only thing that changed was the paper price on a screen, driven by a mechanism designed to punish people who borrow money. So Friday wasn't a crash, it was a cleansing. And now that the room is clean, the big players are walking back in. Now, let's look at the smoking gun. This is the part that should make you angry, but it should also give you clarity. Turn your attention to CNBC. The headline is crystal clear. Wall Street banks are saying buy the dip in gold and silver as the metal recovers Monday. Think about the psychology of this. Imagine you are a retail investor. You watched your portfolio drop 26% on Friday. You are scared. You are thinking about selling everything to save what little cash you have left. And then, On Monday morning, while you are licking your wounds, the biggest banks in the world are issuing buy notes to their private clients. Why are they buying? Because, as the CNBC report highlights, the thematic drivers are completely intact. What are these thematic drivers? The banks list them out explicitly. 1. Global debt. The U.S. debt is still skyrocketing. Kevin Warsh can't fix that overnight. The interest payments alone are unsustainable. The system requires inflation to survive. 2. Central bank buying. China, Russia, and India are still buying gold and silver to diversify away from the dollar. They didn't stop buying just because of a nomination. They are buying more because the price is lower. 3. Geopolitical instability. The world is becoming more dangerous, not less. Safe haven assets are required. The banks know this. They know that Friday was a sale. In fact, I would argue that this was a coordinated transfer of wealth. Institutions cannot buy when the price is parabolic. They cannot buy when everyone is watching and the price is 122s. They need liquidity. Do you know where they get liquidity? They get it from your panic selling. When you hit sell at the bottom because you are scared, who is on the other side of that trade? Who is buying the contract you just dumped? It's not another retail guy. He's scared too. It's the algorithm of a major bank. They provided the bucket to catch your tears. And now they are holding the asset as it rebounds. Look at the price action today. According to the latest charts, silver has already erased a significant portion of Friday's drop. It bounced hard. Why? Because the smart money stepped in the moment the dumb money stepped out. This is why we follow the data, not the emotions. The data says Wall Street is long. If you don't trust the banks, and I don't blame you if you don't, let's look at another signal. Let's look at the industry itself. According to a report from TS2 Tech, shares of Fresnillo, the world's largest primary silver producer, jumped immediately as silver began to rebound on Monday. The headline reads, Fresnillo stock price jumps as silver rebounds. Why does this matter? Mining stocks are often considered the canary in the coal mine. They tend to lead the price of the metal. These companies have teams of geologists, economists, and analysts. They know the real supply constraints better than anyone. Here is a lesson on operating leverage. Mining companies have fixed costs. It costs them the same amount of money to run the excavator whether silver is $20 or $100. So when the price of silver goes up, their profits explode exponentially. But the reverse is also true. If the price crashes, their profits should vanish. If the crash on Friday was real, if the market truly believed that silver was going to $50 and staying there, Fresnillo stock would have continued to tank today. Investors would be fleeing the sector expecting lower profits for years. But they didn't. They bought the stock. They bought it aggressively. This tells us that the equity markets, the people betting on the companies that dig the metal, see this crash as temporary. They see it as a blip. TS2 Tech Analysis points out that investors are looking past the Warsh news and focusing on the revenue. The revenue for these miners is driven by volume and long-term average prices. They know the shortage is real. They know that grade quality is declining. They know that no new major mines are coming online in 2026. So let's recap the scoreboard. We have Wall Street banks buying the metal. We have equity investors buying the miners, and we have Societe Generale telling us the crash was just positioning. The only people selling were the people watching the 1-minute chart and panicking. I want to pause the technical analysis for a second and talk to you, man to man, investor to investor. Friday was hard. I know many of you are new to this channel. Maybe you just bought your first ounce of silver last week. Maybe you bought at the top, and seeing a 26% drop feels like a punch in the gut. It makes you question everything. Did I get scammed? Is the silver squeeze a lie? Should I just cut my losses? This is exactly how they want you to feel. Wall Street operates on a cycle of fear and greed. They use greed to get you to buy at the top when they are selling, and they use fear to get you to sell at the bottom when they are buying. If you want to survive in this market, if you want to actually build wealth and not just be liquidity for Goldman Sachs, you have to break that cycle. You have to become anti-fragile. How do you do that? 1, you stop using leverage. The people who got wiped out on Friday were the ones trading on margin. If you own the physical metal, you survived. No one came to your house and took your coins. You still have the same number of ounces. 2, you zoom out. Look at the weekly chart. Look at the monthly chart. Look at the supply deficit data from the Silver Institute. Does a one-day candle change the fact that the world consumes 1.2 billion ounces and only mines 800 million? No, that math hasn't changed. 3, you ignore the noise. Kevin Warsh's noise. Margin hikes are noise. The signal is the empty vault in Shanghai. The signal is the premium at your local coin shop. We talk a lot about diamond hands in the crypto world, but in the precious metals world, it's about iron conviction. You have to know what you own. If you know you own the most undervalued strategic asset on the planet, then a 26% price drop isn't a crisis, it's a coupon. Now, a critical reminder for everyone, especially the thousands of new subscribers who joined us this week. I have seen the comments. I have seen the imposters. I want to make this crystal clear, just like OG John AG does. I do not sell courses. I do not have a paid mentorship program. I do not have a private WhatsApp, Telegram, or Discord group. I do not sell trading signals. If you see a comment below this video with my photo asking you to message me for financial advice or linking to a crypto scam, that is not me. Those are scammers trying to steal your money. Please do not send money to anyone claiming to be me. Block them. Report them. My only goal here is to provide a clear, unfiltered view of the markets. I read the news, I analyze the data, I share my journey. That is it. I am independent. I am not sponsored by a bullion dealer. I am not sponsored by a mining company. I am here for the truth. And the truth today is that the bull market is alive and well. So, where do we go from here? The rebound has already started. We are watching the $83 level closely. If silver can hold above $83 and close the week strong, then Friday will officially go down in history as a bear trap. The market structure damage is being repaired. The weak hands are out. The leverage has been flushed. The question you have to answer for yourself is simple. Do you trust the sentiment of a panicked crowd? Or do you trust the actions of the biggest banks in the world? They are buying. Fresnillo investors are buying. The factories in China are buying. I know what I am doing. I am holding. And I am looking for opportunities to add to my stack while the prices are still suppressed by this fake paper game. I want to know what you think. Comment below. Do you think the crash is over? Or is this a dead cat bounce before we go lower? Do you trust the Wall Street buy signal? Let me know in the comments. I read all of them. If this video helped you calm down and see the bigger picture, hit that like button. It helps the algorithm show this truth to other people who are panicking right now. And if you want daily updates without the hype, hit subscribe, stay strong, stay solvent, and don't let them take your silver. I'll see you in the next one.